So moving from that to the bottom-up process where you're actually going through the issuers and you're looking through the floating rate notes and the corporate debt and the asset-backed securities, how does that process work?
Yeah, for sure. So if I start with a company, be it a bank or a real corporate, I call them real. Banks, one of the things people don't really understand about banks is the concept of money is different to a bank than any other person or a company. For a bank, money is inventory, is the best way to put it. That's the product they're selling, is money. And it's very easy to get more of, except in the most terrible of market conditions. It's more the price they pay to get that money. But anyway, sorry. So in the case of sort of more corporate analysis, there's obviously an element of that that's financial information gathering, modelling and forecasting. You have to understand how a business works, what are its sources of income, where are its customers coming from, and business strategy, and I guess like corporate strategy. So we spent a bit of time in at the desk on the spreadsheet, going through that kind of information. We then always make sure we talk to the company. We want to understand from management some of these softer things like what is their strategy, how are they going to build and grow their business, etc. We like to have a good understanding of the competitive environment. So where is this business positioned in its market? Why does it have an advantage, or where's it sourcing its customers from? And then what are its relative strengths and weaknesses? And frankly, most businesses have some weaknesses somewhere. In the case of banks, there's a lot of time spent, for example, on the process they use. We want to understand, are they writing conservative or aggressive credit when they're lending money, simplistically. And that often actually is quite different between businesses and residential or consumer lending. And then we look at the competitive position, speak to management, and then we also want to sort of gauge, I guess, from more a customer perspective, what are the reasons to keep using this business? It gives us a bit of a sense of what's the growth outlook for this business like. Where can they source customers? Is there really value for those customers? And that kind of like. So there's that sort of activity for companies. What we then also like to do in the case of, say, something like it's pretty important for banks, and this is perhaps one item that almost could be put in a top-down bucket or bottom-up. It's just part of our process, and I guess it sort of sits somewhere in between, is to think about the liquidity profile through time. So is this entity going to continue to participate in the market? That will have an impact on the liquidity of their bonds. But then equally, how reliant are they on participating and issuing more debt or more equity for that matter? So there's a fine balance that you want someone to be regular in both markets, equity and debt, assuming they're a public company, of course. But at the same time, you don't want their core needs to have to be financed out of those markets. Otherwise, there's a particular vulnerability, and you sort of have to discount in, well, if we're investing in that kind of business, then we would up the expected cost of capital for that business, because at some point they're going to have to issue and source capital at a very expensive price. So again, prefer not to go there, but it's all about getting a really good understanding of where each individual business is at, and whether its situation is likely to be net improving, roughly staying the same, or deteriorating. And that also includes talking to people like management, directors, testing and probing and making sure that their procedures and controls are strong, robust, and that some of those sort of fraud kind of risks are managed well. None of those kinds of risks are entirely avoidable, but you want clarity that they're being managed well. When it comes to RMBS, we do spend a lot of time on understanding both the loans that are in the deal that's being done, as well as the issuer, and of course, in each deal, there's sort of structural elements to the way they build the subordination, and sometimes they put other little frills in the way that the payments work, and we spend a lot of time on really understanding the cash flow structuring. What does that look like in terms of like on an investment? We do loan level analysis on every single investment. So, an RMBS is coming to market, say late this week or early next week. We've already got an established relationship with all the issuers, and so they will flag, look, we're bringing a deal to market. Here's our pool. Here's our loan pool. And again, we'll do a loan level analysis so that we don't know anyone's names. They're anonymized in terms of that way, but we do know the postcode people live in, the size of loans, their arrears history, and all that kind of stuff. And we do a probability default at a loan level. Obviously, aggregate all that up, and then we play around with the particular characteristics. And if particular scenarios were to occur, how that might adjust and change the defaults. But then also in particular, because you can attach this default likelihood to a particular property, you know what the valuation is, what date it was done, and the LVR, sorry, and so it allows you to sort of cross-reference if this does default. Where's what has to happen for us actually for there to be a loss? And again, that's a bit of a scenario testing kind of thing. Aggregates up, and obviously we want to stay away from anything we think could see a loss. As I said before, we do a bit of cash flow analysis. There's some deals are really simple and vanilla, but some they just throw in some cool little bits that make it a bit confusing and save them a bit of dollar. Like the issuer will make a bit more money if they do some of these things. So spend a lot of time on really stressing what that impacts are and where that could be good or bad for different notes, because they typically are good for senior notes and not as good for other notes. So we'll play around and push and pull that in assumptions to just see risks there. And then probably the last piece of the puzzle is it's all about understanding what's the actual stuff that the stuff that happens to get those loans there. So that's underwriting risk. So you spend a lot of time with issuers understanding their processes. What do they believe about credit risk? How does that manifest in their process about who they're going to reject and who they're going to accept? Where are their limits? And then the all important collections. You really need to understand what are the processes an RMBS issuer uses to collect, because we found that sometimes some issuers are so upfront and proactive with their collections process, and it's a positive. They try and make it a positive process with their borrowers that they have very high arrears, and so when you sort of get the standard information from the issuer and I guess the deal originator, the arrangers, it might look like an average issuer. They've got high arrears. They seem to have high arrears in all their deals, but when you fully understand how they're collecting, when they're making phone calls on collections, what that experience and interaction is, what their appetite for putting someone on payment arrangements is, it puts a lot of this other stuff into context, and we make a bit of adjustments on our thinking on like arrears and expected losses based on these qualitative discussions and I guess investigations of the process they use. I've said a lot there. Sorry.
That's okay. I have two follow-up questions. So, how many issuers are your team actively following and engaging with? And the second follow-up question, after you talk about the issuers, we mentioned prior to the podcast, you mentioned an example of one issuer where at first pass you might think that they were quite risky, but when you looked at the nature of the loans, and I won't spoil the story, I'll let you tell it, they're actually a lot less risky than they might otherwise have been, and therefore offered pretty good relative value. But I'll let you talk about that story.
Yeah, for sure. So to answer your first question, there's probably, it actually keeps growing, but there's sort of 15 active issuers in the market, and there's more that are irregular issuers in RMBS. The major banks have not really been playing for a while, and even the regional banks have been issuing a bit less. And I think it's that TFF I talked about a lot earlier in the discussion. And so we have really strong working relationships with probably about 10 of them, and we talk to the senior people at these non-bank lenders at least monthly, and in some cases, someone in the team might be almost talking to them weekly. So we've got strong relationships with the CFOs and the CEOs and the head of funding and all these different bits and pieces. So that's to answer your first question. Your second question. So yeah, we've found that when you engage you build a relationship with these people and they're happy to share more and more detail. We've kind of started in a few instances asking them about some problems. So I kind of half referenced before that there's one or two issuers that have some quite structurally high arrears. And so I'm thinking of an issue in particular, but I won't name them. We kind of sort of found ourselves talking to them about, here's a new deal coming. What do you think? And we're sort of like, well, we've kind of got a problem with the arrears. Can we were planning to skip this one, but can we talk to you more about some of that? And what we found when we sort of sat down with them, talked to some of their managers in their business about how they were originating loans and then how they manage collections, we kind of realised that they structurally, and they were who I was thinking of just a moment ago, they structurally are going to have higher arrears, and it's not because that's necessarily going to lead to higher defaults. It's more the way they work with their customers. So this issuer has a little bit higher exposure to tradespeople. And tradespeople are either subcontractors or just raw self-employed. And so their incomes are variable, I guess, in nature, and they're not, but they're not very binary. So, people that have a PAYG job, they go to their work and they get paid every fortnight. If they're casual, obviously the pay varies, but the point is, they've got a bit of a binary kind of outcome. So if they lose their job, then their income falls to zero. Whereas tradespeople, that's not kind of what happens. They get quiet. So what do we have in 2019? We saw a total collapse in building. I feel like it was 2019. It seems ridiculous if you've tried to get tradies in to help with anything on your house over the last 12 months. But in 2019, there was a big drop in a building, and so a lot of tradies' incomes fell. But they didn't fall to zero. They fell to 60% of perhaps what they were earning before that. And so this business, knowing the customer, when they come to collections, they're very quick to communicate with people. They've got sort of multi-platform style communication. So it's easy for you to know you're in arrears. It's also easy to communicate back where you are early in the process. I think they accept texts as their response, for example, which I was pretty surprised about. But they are very realistic about having very long payment arrangements and workouts with their customers, because they know that there's cyclicality in the income, but through time, they've already in the underwriting considered that cyclicality, that through time, these people can make it good, and they certainly are very comfortable to ask for extra and get, for you to get yourself out of payment arrears when the times are good, like presumably they are now. So like that issue is a really interesting one. So we used to, as I said before, sorry, I feel that's a little long-winded, but as I said before, we were looking at them in a pretty negative light. Whereas now we sort of make adjustments to their arrears numbers in our internal risk modelling, because one of the things they brought our attention to is the arrears to default transition, and the fact that they might have run arrears double the industry, but their defaults were less than half the industry, and really showed the steps in the process, gave us some living examples of how people can easily get to 60 days arrears, but they're quite good at keeping them within 90 days, and they're willing to have the hard conversation if someone does get sort of 4 to 6 months in arrears kind of thing. So, that was a really good example of someone who we were a bit hawkish around, had a really good engagement, a series of engagements, built some good relationships, and a good understanding of the process that leads us then to be able to invest. And the beauty of an issuer like that is they tend to invest and, they tend to issue and they offer a tiny return premium because the market considers them riskier. So we're then comfortable to sit in there more regularly, investing in those deals, collecting that premium. Not usually a huge one, I will admit, but that premium, and sometimes the premium might be through more credit enhancement. So even lower risk, might not be a return premium. It's a risk, lower risk premium.
I guess that shows the value of having the resources internally to be able to have those conversations and dig a little deeper, and find these issuers where, just because the people they're lending to have different circumstances doesn't necessarily mean that they're a riskier mortgage customer. So I think that's an interesting way to illustrate your process and how you're having the people in the team that can do that work is helping you unlock, as you said, a small return premium that otherwise you might have overlooked, thinking that it was too risky. Podcast is for informational purposes only. It does not constitute financial advice or take into account the particular investment objectives, financial situations, or needs of individual listeners. Listeners should consider whether any opinions or recommendations in this podcast are suitable for their particular circumstances and, if appropriate, seek professional advice, including tax advice.